Thank you very much, Paul. And thank you all for showing up to the last meeting of 2024 and the last roundup of the markets we'll do in the tech update as we round up the year of 2024 and also look ahead to what's in store for 2025. Nothing that you're about to see or hear is a recommendation to buy or sell any financial instrument. I'm sure you're all well aware of that. Do your own homework and place your own bets. The quote comes from the pop singer Yaz from her 1988 hit, "The Only Way Is Up," because that's certainly what all the markets appear to be doing right at the minute. As we look straight into the US stock market, first of all, and as it's the last one of the year, we always like to have a look at the sort of big picture. So this is the Dow going all the way back to 1900. And as you can see, what the stock market likes to do is it has these large, long consolidation phases, and then it punctuates the space between them with these long trending moves. So we've basically had three phases of this since the 1920s, basically. But what's interesting is if you put the numbers against them, where we've come from since the bottom of 2009, we're now starting to reach into the area where we might expect that this market to start thinking about taking a pause. So that's certainly what worth considering on a longer term basis. Remember, this is a 120 plus year chart. But on a long-term basis, we are starting getting towards some sort of pause, I think. But if we dig down into the nearer term chart, this is the monthly chart on a log scale. And while yes, the market is starting to look a little bit extended, you cannot really say that in the basis of the trend lines that it is at an extreme at this point or not. We've gone through 5,000, we've gone through 6,000. But we're not yet near the upper trend line. And on a log scale, that upper trend line is actually above 7,000. So the market could still have a little bit to run. But if we look at it on a weekly basis, you can see that it has been going up for a long time without any sort of meaningful pause since way back here in October, really, with the last meaningful correction that we had. And so you would expect that at some point we will see a correction coming in. But, 6,000 is obviously a key level whether we see the market taking some pause there or not, we'll have to see. On the Ichimoku chart, the price and the Chikou span both well above the cloud, and the cloud providing support there down around that 5,400 to 5,700 area. So let's dig into the market internals and see what the health of the market is telling us under the hood, as it were. As we look first to the market breadth, so this is the bullish percent index for the S&P 500. This tells us the percentage of stocks which are bullish or bearish. And as you can see, it's currently sitting around 64% of stocks, which is a reasonably healthy number. And you can also, the other thing you can see from this chart is that we're continuing to make peaks up around that 80 level. And that's healthy for this market. We're not seeing any divergence. We're not seeing lower highs coming in or anything of that nature. So this is really backing up what we're seeing in the broader market, that the market is being widely supported by a large array of stocks which are going up. The participation is not narrowing, at least not on this chart. Another way we can cut that is to look at stocks above their 200-day moving average, and this has given us a very similar picture, if not a little bit more bullish. Currently sitting at 67, but you can see where it's been. It's been in a very narrow range at very, very elevated levels, once again, just indicating that wide participation in the market at the moment. If we start to look at the ratios within the market, so if we look at the discretionaries versus staple, this tends to be a leading indicator of where the market's headed. You can see back there in the middle of the year, we did have this ratio starting to fall off while the market was rising. That showed a little bit of divergence in that instance, but you can see the market's just powered straight through that and left the divergence in the rearview mirror, if you like, because this ratio is now sitting very high, and once again, that's bullish for the broader market. On the advanced decline, on the semiconductors versus the S&P 500, we are just seeing that starting to lose a little bit of momentum at the top there. obviously some of these crazy valuations that we've seen for these AI stocks, particularly the chip makers like Nvidia and so on, people are starting to think, maybe they've got a little bit of ahead of themselves. So that's perhaps just some of the steam coming out of the market that's causing that to turn more sideways there. But on the advanced decline line, again, this is giving us that story of the wide participation of the stocks underlying the index itself. They're all heading up at the same time, and we're seeing this the advanced decline line broke out above its old high from 2021 there, and it's sitting more or less at all-time highs there, once again agreeing with the market as it's going up. Looking at how the three big indexes have performed this year, what's interesting from this chart is if you look at the Nasdaq and the S&P, how they've swapped leadership as the years gone on. The Nasdaq, getting very frothy at points with the AI story as that's waxed and waned. But interestingly, they've both ended up more or less at the same point, which is up about 27 or 28%, which an average year in the S&P 500 is about 7 or 8%. So this is almost 4 times what you would expect for a given year. So it's been a very, very bullish year for the stock market. The Russell 2000, which is the small caps index, you can see it was very choppy in the early part of the year, but it's actually played a bit of catch up in the last quarter there, and it's finishing up about 20% for the year. So again, that's a very good result for it as well. Having a look at the sentiment indicators. So the first one's the yield curve, and you can see that the short end of this curve is still very elevated. It's no longer looking inverted, which it was for quite a long period, quite a few months, but it is still looking fairly flat, which does still indicate that there's a lot of risk around in the market. If you can get 4.5% for short-term bonds, why would you put your capital into the stock market and take all that risk with stocks? So that will eventually drain market out of the stock market if it remains at those levels. But the other thing that the yield curve tells us is the possibility of a coming recession, because higher interest rates obviously bite on the economy. It makes borrowing costs more expensive for companies that want to expand or buy new equipment. And so you can turn that into a probability of a recession, which the New York Fed have done, and they come out with a number of 57%, so slightly better than a coin toss, or 6 chances in 10 almost of a recession in the next 12 months in the US. And, who knows, with the policies of the incoming administration, the tariffs being talked about and so on, whether that may have an impact that trips the economy into a recession. Another sentiment indicator we can look at is the put-call ratio. So this measures the ratio of puts to calls in the market at the moment. And this is actually very low at the moment. It's down at 0.51, which indicates that there's almost 2 call contracts for every 1 put contract in the market. So that indicates that the market participants are very, very bullish. They're willing to go all out on calls. They're willing to cut all their downside protection. In other words, they all think the market's going to go up forever. And usually when the market gets that lopsided, it ends up in some sort of top. So we're not there yet, obviously, because you can see this has been in that so-called bullish extreme area for quite a number of months, and we've not seen any negative effect in the broader market. But if we look at this on a longer term basis, there's a 5-day moving average of this at the top there, and you can see once it gets down below that 0.5 level, that has in the past quite a number of times been an inflection point for the market. We're not quite there yet on the current indications, but this would be one I would be keeping a close eye on in the next couple of months. On the VIX, where we're still sitting right down in that what I call the low risk area, down below the sort of low 20s, that indicates that, again, people don't have an appetite for downside protection. So the price of the VIX is very cheap at the moment if you want to buy protection. And the old saying in the market is you buy protection when you can, not when you must. But the VIX, as you know, is a mean reverting index. So when it gets very low, it tends to spike up and vice versa. but it can stay low for long periods, as you saw through late 2023 and most of the early part of 2024 as well. In fact, the only real sort of meaningful spike we've had since 2022 is the Japanese central bank's interest rate decision in August, which spiked the VIX up. But within a few days, it was back down in its low risk zone again. So again, this is agreeing with the market going up. Market participants are bullish on the market. They're not spending a lot on downside protection. And so it becomes a self-fulfilling prophecy until it doesn't. CNN produced a fear and greed index. This basically takes a bunch of sentiment indicators and market breadth indicators and sort of distills them down to a single number. The calculations open and available. You can go and have a look at how it's done. But what's interesting here is you can see it's sitting right in that neutral area. So there's no extreme, certainly not extreme greed that we're seeing at the moment, according to the way that they've compiled this. And the other interesting thing is it's actually been dropping in the last few weeks as well. So people are getting less bullish, if that makes sense, despite the market continuing to rise. So we would expect a market top to coincide with this indicator swinging way around into the 80s or 90s, but we're obviously not seeing that yet. On the seasonality, well, we've almost got basically the full year completed now, and the actual year to date on the S&P is down the bottom there. And you can see it's almost a picture perfect analog of what the seasonality chart was telling us. We saw the market go up for the early part of the year into about April or May, and then we saw that sort of sideways period that we would normally expect through the northern summer. And then as we come in towards the back end of the year, we get that bump up in price as well. So if you'd done nothing else and just followed the annual cycle, you probably would have come out okay in the market. And the reason why the last quarter of the market is so bullish is because that's where the cluster of the best returns tend to be. The so-called Santa Claus rally and all that tends to happen around about this time of year. So if you did nothing else but bought in November and sold in May, as the old saying goes, you would probably do okay. On the election year, so the presidential four-year cycle, the election year, of course, was this year. And again, it was a pretty good facsimile for what happened in the Dow itself. So the Dow's down the bottom here. We had that sort of choppy sideways start to the year into about the middle of the year. And then the market took off in line with what the cycle was expecting us to do. We even had that pullback that we got just prior to the election. So again, it's been a very good year for the cycles. They don't always work this good, but this year they have. The decade and the decade cycle, which just marks the sort of the last number of each year, we're about to head into 2025, and just so happens that according to the decade cycle, at least, that is the most bullish year of all 10 of them. So we'll see how that one works out. The other one I thought I'd throw in here is the real estate cycle. If you follow this, it's on an 18 or 18 and a half year cycle. The last big crash, as you know, was back in 2008. So add on 18 to that, you get 2026. And what happens generally before you get to the crash point is you get this huge, what's called winner's curse, where everything just goes up. And you have this huge asset price bubble, real estate, stock market, you name it. And that's where we're just about to start heading into as we head into 2025. So if this cycle holds, and it seems pretty reliable, then we could be looking at a boom time in the markets prior to 2026, when you might want to start removing some of your chips from the table. Switching now to the Aussie stock market, and well, it's been having a decent run, actually. As you can see on the monthly chart, we broke through the old 2007 highs back in 2021, I think it was, or yeah. And then we had sort of 2 years of kind of sideways action as it got trapped below that 7,600 level. But you can see in the last few months, we're now clear of that, and it is starting to look very bullish. On a weekly chart, you can see it a little bit clearer there. Broke through the 7,600 level, and it came back, tested the top side of it, and it sort of progressed in a reasonably well-behaved uptrend. So while it is starting to look a little bit extended to the upside, it's certainly we're not seeing additional volatility coming in that you might associate with a market top. So steady as it goes for the ASX 200. And on the Ichimoku, well, it's obviously very bullish. The price and the Chiku span both above the cloud, and the cloud sitting down at that 7,400 to 7,800 level. But despite how good a year, how good a little run it's had, it's actually not had a great year. It's the poor man of the Asian and well, certainly the S&P 500 in a class of its own. But if we compare ourselves against the other Asian indexes, you can see the ASX 200 only done about 10% for the year. Next is the Nifty, about 13, and then you've got the Nikkei and the Hang Seng about 19, I think that is, and then the S&P 500 is the 600-pound gorilla in the room there, up about 26 or 27%. This chart's always a fun one to look at. This is just the XJO divided by the S&P 500, and you can see from the start of 2023, it's actually dropped 27%. So it's underperformed the S&P 500 by 27%. So if you put 10 grand in both markets back in 2023, your investment in the ASX 200 would be worth 27% less, not accounting for any currency conversions, of course. And you can see, you know, if this was a price chart, you certainly wouldn't want to be a buyer, would you? So I guess, the story behind this chart is really the story of AI, because that's what's been driving up the US market, and the Australian market just doesn't have any of those big, massive growth stocks. It has a few little tech stocks, but most of the market, as you know, is dominated by finance and resources, which haven't really been storming ahead as much. Switching to the currencies, then the US dollar index, well, it's trapped between that sort of 100 and 107 level. Of course, this is a monthly chart, so the last sort of few months there, you can see, you could probably call that the Trump bump, if you like, because it now looks like the sort of policies that he's talking about bringing in will basically put a lid on the further interest rate drops by the Fed. So, in fact, we may even see rate rises coming, and that's certainly given currency traders cause for hope to start buying the US dollar. So, on a technical basis, if it can get above that 107 level, as you can see, it can probably try for the old highs at about 114, that spike high there. And of course, a strong US dollar means weakness in the other majors. And of course, for the Aussie dollar, we're seeing that strong dollar is hampering the Aussie dollar, but it's also because we have a very sticky high cash rate compared to the Fed, which have been cutting theirs. On a technical basis, it's fallen, well, I mean, it's fallen quite a bit from that 80-cent level over the last couple of years. And its lower highs and lower lows, it's not really rocket science about which way it's headed. But on a technical basis, it's trapped between that 69 and 63 area. If it goes through 63, then I think we can look towards 60 as being the next line in the sand for the AUD. And on the euro, it's a similar picture, of course, but slightly different technically. We have this downtrend line that's really been way in place since going back all the way back to 2008. So we've got sort of multiple descending triangles which have been completed, and we got that sort of spike down to where we hit parity with the US dollar. It's now bounced back above that level, and you can see it's come back into the pattern from that false break above the downtrend line. And it now looks like it wants to make another attempt on this 103 level. So if it goes through 103, then we'd have to look towards parity again for the euro. And on the yen, well, I mean, it's just been going down constantly. again, because of the interest rate differential, the interest rates on the Japan have been more or less zero. Well, they've been negative, in fact, until the Japanese central bank decided to step in and raise them by a very, very small amount. So what that's done is it's basically stopped the bleeding, and we've now seen a little bit of a bounce off support. So even despite the fact the US dollar is rising, we're seeing buyers coming in to support the yen. But the big story in the currency markets, of course, is Bitcoin hitting 100K as it did this couple of weeks ago, in fact, or last week. Unbelievable, really. And you can go back and check the recording. Somewhere in here, I was telling everybody that Bitcoin was heading for 100K, and there was a lot of shaking heads in the room, but it's doubled, and it's doubled again, and it's done that all in the space of, what was that, less than 2 years. So it's been quite the story. Obviously, on a technical basis, it's starting to look a little bit overextended. Everybody was obviously rushing in to get it up to that 100K level. That's obviously a massive psychological round number. So we'll see what happens when it gets there. I would say it would take a pause. Whether it gets all the way back to 69 or not, I don't know. There's Trump is the meme president, so he's talking about buying Bitcoin for the U.S. Federal Reserve and God knows what. So who knows what the demand can hold with this thing? But very bullish for Bitcoin. It's been the star performer this year, no doubt. Lastly, rounding off on the commodities and energies, all looking very weak at the moment. This is crude oil on a weekly basis. And the story is, of course, that very pronounced descending triangle that you can see there. It's had multiple attempts at this support line around about that 67 and a bit dollar area. It's not got much more time left before the triangle runs out, so it's got to make a decision one way or another. Obviously, the slowdown in China and what have you is playing into this as well. But if it goes through 66, then you would have to say, given the number of times it's attempted it, it could probably be quite a quick move down into the 50s, and who knows, maybe even $50 before too long. There's no obvious line of support going back in the chart. On copper, it's kind of the opposite story. It's in an ascending triangle. It had that kind of run up there as it broke through that 485 pounds per dollar it's priced in. It's come back into the pattern. It's just wiggling around. It's not even higher highs or lower highs. It's kind of just sort of grinding into this consolidation pattern, and then we'll see which way it breaks. You probably have to favor the upside just slightly. Obviously, copper, a big story in the green tech revolution and what have you, but sideways mostly for copper for now. On iron ore, it's also mostly a bit of a sideways story, so not much to write home about here. It's trapped between that $90 and $130. You can see those downtrend lines sort of leaning on it. Obviously, it's tied up in the Chinese slowdown story as well. So it has had a break up. I'm not sure if that's an artifact on the chart or if that's real, but it's just floating around about that sort of $100 area at the moment. But you would probably want to favor the downside with iron ore. But always good to finish on a high note, which is gold, and it's been sort of just going up and up and up. It broke through that 2084 level, and it basically hasn't stopped since then. It's just taken off like a rocket. So very bullish for gold. Again, you would maybe just say it's starting to look a little bit overextended. We'll probably get some event before I do the next one of these where everything just goes down all in a rush. So keep your eye out for that. But in the meantime, if you're holding gold, good luck to you. So just to summarize that, US stock market's obviously still looking very bullish, even widely supported if you look at things like market breadth. Maybe just a couple of sort of warning signs starting to appear with things like sentiment starting to look a little bit overheated. On the Aussie 200, we've got that break through that 7,600 level, and it's still looking very bullish. for the Aussie 200. On the currencies, it's a bullish dollar because the interest rates there are expected to be at least on hold, if not starting to rise again. That means weakness elsewhere. But we've seen Bitcoin now through 100 grand, so that's in a market of its own, really. And on the commodities, well, we're looking at weak energies, metals pretty much gone sideways, and gold going up. I'll just round off on having a look at, this is one of the strategies I have on smartsystematictrading.com. It's a trend following relational system, trades NASDAQ 100 stocks. It's had a very good year, as you might imagine, with this AI story up 45% for the year. So not unhappy with that, of course, for a sort of 26 compound annual return normally. There's more information on that and other strategies there at smartsystematictrading.com. Thanks very much for your attention. I wish you good luck, good trading, all the best for 2025, and thanks for now.